Bond price dynamics. In the previous clip, we examined a zero coupon bond. And it's useful to start with that bond in order to understand the dynamics of bond prices. The zero coupon bond is the simplest bond, and let's consider a bond that has 1 year maturity like we have before. And suppose the price is 90, which delivers an 11.1% rate of return. Now, the question that we ask in terms of bond price dynamics is what happens to the price of the bond when the interest rate in the economy changes. So in earlier clips I told you that the fundamental causes of the change in the interest rates would be related to economic activity, expected inflation, the correlation between economic activity and expected inflation, and the degree of risk aversion in the economy. So, given all of these possibilities, interest rates could change. For example, suppose that there was some announcement from the Federal Reserve that inflation was likely to increase. Or suppose that the oil price dramatically shot up like it did in 1973 and 1979. People investing in bonds would demand a higher rate of return. What does this do to the bond price? Well, if we're at 11.1% rate of return and people demand a higher rate of return, then the only way that this can happen is if the price of the bond actually goes down. So if we go down from $90 to $89, then the effective rate of return on that bond increases. So the price of the bond will decrease as interest rates increase. Now, sometimes this can be a little confusing because people confuse often bond prices and interest rates. So when you hear a news report of the bond market rallying, and rallying usually means going upwards, this does not mean interest rates increase. It means that bond prices are increasing. If we increase bond prices, so if we go from 90 to 91, interest rates are actually decreasing. Okay, so interest rates and bond prices move in opposite directions. So if we demand more in terms of a rate of return for a bond, and because it has a fixed price at expiration, the price today must decrease. Now, we'll actually go and measure the sensitivity of the bond price to a change in the interest rate. And that sensitivity will be called the modified duration of the bond, which is the subject of another clip. But the fundamental intuition I want you to understand today, and that is that as interest rates increase, prices of bonds must decrease. Okay, now what is really the essence of what's going on here? If you are offered this bond that we've been talking about, this hypothetical bond that's trading at $90, and it is yielding an investment rate of return of 11.1%. Suppose you're offered this bond for $90. But there's some other investments out there that are the same risk, but will return 12%. Well, this is the same case of no arbitrage that we discussed before. that nobody's going to buy this bond for $90. And the only way you're going to be able to sell this bond is to decrease the price. So once the price is dropped from 90 to 89, then there's going to be a market for the bond. So it makes sense in terms of supply and demand. It makes sense in terms of no arbitrage. So nobody will purchase a bond that is yielding 11.1% when the going rate of interest is 12%. The bond price must decrease. So by this supply and demand, we see the essence of the bond price dynamics. Interest rates go down, bond price goes up. Interest rates go up, the bond price must go down. Now, we're actually going to be quite concerned about measuring the degree of sensitivity of the bond price to a change in the interest rate. So it turns out that I said that the U.S. Treasury bill is the least risky bond, in that it's very unlikely that you're going to actually lose in terms of your holding period return on a Treasury bill. It turns out for any zero coupon bond, if you hold that bond to maturity, then you are guaranteed the rate of return that you purchased the bond at. For example, the Treasury bond with the zero coupon that has 2 years to maturity that I buy for $80. Over the 2 years, my rate of return will be 25%. That's guaranteed. Works out to about 12% a year. But suppose what happens is that I buy the bond for $80, and then a week later, there's a dramatic surge in interest rates. So suppose the Fed initiated some other experiment that caused panic and much higher expected inflation. Well, the annual interest rate on this bond is about 12%. And suppose that the annual interest rate for investments like this bond increases to 15%. Well, it turns out that nobody would be willing to purchase this bond for $80. It turns out that if I held this bond to maturity, if I held it for 2 years, I'm going to get the 12% per year. Simple. But if I choose to sell this bond today, it turns out that I'll probably only be able to get about $68 for it. So if I bought the bond for $80, there was a change in the interest rate environment within the week, and I had to sell the bond, then I'm going to take a loss on my investment. I paid $80, and I'm going to sell it for $68. And we calculate our investment loss by taking the same formula, 68 minus 80, divide by my initial investment, which is 80. And it's a fairly large negative rate of return. So with longer term bonds, there's actually the chance that you can have a negative rate of return if you choose not to hold the bond to maturity. And as we'll find out later, the longer the maturity of the bond, so if we're not talking 2 years, we're talking with 30 years or even longer, the higher the chance that you could have a substantial negative rate of return. Actually, there's also a substantial chance you could have a sizable positive return too. So what's good news for the bond investor? If I've got the 2-year bond or the 30-year bond? Well, good news for me is if interest rates, if they actually, in terms of our bond price, we always want the price to go up. So for us, we'd like the interest rates to go down. So good news in the bond market is where interest rates go lower. This will cause a rally, the so-called rally in the bond market. So if I'm holding a bond, a longer term bond, I very much like interest rates to decrease because this will increase the investment value of my bond. So this is a simple exercise in bond price dynamics. When we talk about duration, we'll talk about how this differs for different maturities and for different types of bonds, whether a coupon bond or a zero coupon bond. But the essence of the bond price dynamic is interest rates up, bond prices down, interest rates down, bond prices up. The so-called first derivative of the bond price with respect to the interest rate is negative. And graphically, you'll see in the lecture note graphs of the bond price against interest rates. And that sort of graph is a curve. And the curve is downward sloping. So as interest rates increase, the bond price is decreasing. So in order to look at this in great detail, we have to go through some of the quantitative aspects of bond prices. But it's always the case, as interest rates increase, that the bonds must lose value.